Hello, Paul Gerard from Price Accounting Services. Welcome back to this playlist on rental property videos. We hope this content today is going to be of use to you. This concerns issues when you're selling an investment property or a property that's ever been used other than as your family home. And it may not be of relevance to, in which case skip it. But what we want to do is run through some of the key issues that do come up. First one is when you sell a property, you get a thing called a settlement sheet. Whenever you buy or sell a property, you get a thing called a settlement sheet from your lawyer. Now, your settlement sheet takes the sale price, for example, $500,000, and then it adjusts that for certain things. So let's say I'm the owner of the property and 2 weeks ago or a month ago I paid the next year's council rates, okay? The settlement process adjusts the sale price so that the buyer compensates me, the seller, for the unused period of the rates. So for example, there might be another 11 months of rates that I've paid, but I'm not going to get any value for. So in the standard form contracts, that's a settlement adjustment. So the price will be adjusted, for example, from $500,000 to $501,000. Okay, that's very normal. But that has a tax consequence for income tax and perhaps even capital gains tax, because as the seller of the property, let's say I've had that as an investment property, I would be claiming a deduction, for example, $1,200 for the rates, but I'm getting $1,000 back from the buyer. So I now need to adjust my deduction for that adjustment event. Okay, so little traps that get hidden in when you're selling a property. It generally covers council rates, land tax, water rates. Now, when I say water rates, it's not the usage portion, it's the sewer charges and things like that. The other one is strata levies. Okay, so those are the key areas where you find those settlement adjustments, and that's going to have an impact on tax and or CGT. So something to bring to your advisor's attention or to factor into your own calculations, etc. One other key area if you're thinking of selling an investment property is fixed rate loan break costs. Now, I'm going to give you a really important tip. If you have a fixed rate loan on your investment property and you're going to sell it, it's very important that prior to sale, you break the loan at that point. Why do I say that? Because the cost, let's say there's a break cost. Now, if there's a break benefit, the bank doesn't give you any money. They never have for many years. But let's assume that there is a break cost. If you wait until the property sells, then it becomes a CGT cost. But if you break it during the period of tenancy, it relates to the production of assessable income, and it is, according to Section 8(1) of the Income Tax Assessment Act, it is deductible because the nexus to the income production is satisfied. Simple as that. So a CGT adjustment might be exempt or partially exempt, or at worst, 50% deductible against the gain. But an income tax deduction might be very valuable, particularly if there's a large break cost. So there's a tip for you. The other thing I do recommend before you ever sell a property is to run some calculations. Now, sometimes people sell because something might be financially difficult or financially unaffordable, their cash flow or their family situation or their employment, it's all changed, okay? And I'd be wary about just rushing in and selling without doing some calculations. I have seen many clients tell me that they've sold a property to alleviate their financial situation, only to find that it hasn't changed things that dramatically. Okay, so what do I mean by that? Okay, so consider what you might sell each property for. So assuming that you might be considering sale of any one or more than one or whatever you might be doing, but do this for each property. Estimate what it might sell for. Then estimate what the selling costs, the agent fees, the auction fees, marketing costs, improvements, fixing the property up, all those costs, okay? And notionally estimate what your capital gain might look like. You might need to run this by your tax advisor to make sure that it's not wrong. Once you've come up with that number, that's going to tell you how much profit you're going to have. Now, based on how much profit you're going to have might then guide how much capital gains tax arises. Then there are exemptions, there are concessions, it might be partial or full or whatever. And again, your tax advisor is going to be the one to say, hey, are you aware that you can use the main residence absence rule or some other CGT rule to either fully exempt a gain or partially exempt a gain or such. So the idea is we want to determine what the tax cost will be. So you've ended up with your capital gain or profit amount, then we're going to deduct the tax from that. So we deduct all the selling costs, and ideally what we're trying to arrive at is how much cash am I going to be left with after I sell, pay all my selling costs, pay my tax, what am I left with? And if that number's only small, you'd have to argue, unless there's substantial cash flow benefits from ceasing those loan repayments, then it may not be quite the feasibility issue that you think it might be. And then you have to determine this other point. If I sell this property and after selling costs, etc., I then take the proceeds and the loan is paid out, how much am I left with? And if that number is substantial, it might be that your plan is to apply those funds to reduce your own mortgage or something like that. Tick, that all makes sound logical sense. But if the number's so trivial, then why bother? So really important to run through these numbers to avoid a very costly sale and avoid the situation I've seen many times where people sell a property only to realise it hasn't really changed their cash flow much and they've lost the asset, substantial costs in selling, and it didn't really improve their financial position to any great degree. So something to watch. The other thing to remember, of course, if you're selling is who owns the property. Remember that the title determines the share of profits. Now, that's really important when we're determining a capital gain, because if we're choosing a period of time, for example, when one of the taxpayers or both taxpayers aren't earning income, then it might be that whilst it is a taxable gain, that the taxable gain falls in a period where there's no other income and so substantially reduces the tax burden, okay? So timing and strategies can revolve around that. The other timing issue that is important to understand is, when does a CGT event really occur if I sell a property? Well, the answer is a CGT event is triggered at the date of the contract, not the date it's settled. Okay, so if you accept an offer and sell your property on the 30th of June and it settles in August, it's 30th of June when that capital gain arises. Okay, so important little timing issue, because if you get the year wrong, for example, thinking that, oh, next year my wife's maternity leave, and you've settled and you've exchanged and done your contract on the 30th of June, you might have got it all wrong and the income ends up in the wrong year anyhow. So I hope that's been helpful for guiding you with some of the key issues around selling an investment property. We look forward to you watching some of our other videos in this quite extensive series on property investors, and please subscribe and look forward to seeing you again. Paul Gerard from Price Accounting Services. See you later.